It is Saturday night, March 8th, 2026. Retail investors are watching the price chart. $84. It closed there on Friday. It looks calm. It looks like nothing happened. It is not calm, and something very specific happened. A standard COMEX silver contract represents 5,000 troy ounces of silver. At $84, that contract is worth $420,000 of exposure. With initial margin requirements currently at approximately $25,000 per contract, that is 16.8 times leverage. Qcoin 16.8 times. Every $1 silver moves up. A short seller with 10 contracts loses $50,000, real money, immediately, against a $250,000 margin deposit. Silver did not close at $84 quietly on Friday. Silver closed at $84 after trading as high as $95 earlier this week. After the Iran war premium, the NFP minus 92,000 shock, the Trump unconditional surrender post, and the COMEX delivery crisis all compressed into 5 trading sessions. The hedge funds that were short silver at $75 or $80 heading into this week are not sitting on a small loss right now. They are sitting on a loss that, depending on their position size and entry point, may have already consumed their entire margin deposit. And here's what most people watching the $84 number do not understand. The margin call process does not wait for Monday. It already started, tonight, while you are reading this. Let's build the full mechanism from the ground up. Every number I give you is public and verifiable. Links are in the description. Section 1. How leverage works. The mathematics that turn a $10 silver move into a fund-ending event. Before I show you what is happening right now, I need to walk you through the exact leverage mathematics, because without understanding the numbers, you cannot understand the severity of what happened this week to the institutions that were short. A standard COMEX silver contract represents 5,000 troy ounces. At $75 per ounce, that contract represents $375,000 of exposure. With margins around $25,000, that is approximately 15 times leverage. A move of only a few percent can chew through a lot of posted collateral. A violent day can turn into a scramble for cash because the market does not wait politely while you decide whether your thesis is still correct. Financial content. Let me make this concrete with a specific example that reflects what happened this week. A hedge fund shorts 100 silver contracts on Monday morning, March 2nd, when silver is trading at $82. Each contract is worth $410,000. Total position exposure, $41 million, required margin at $25,000 per contract, $2.5 million deposited. The fund is controlling $41 million of silver exposure with $2.5 million of actual cash. That is 16.4 times leverage. Silver moves to $95 on Tuesday, March 3rd as the Iran war opens and the safe haven bid hits the market. The fund's position is now worth $47.5 million against an entry of $41 million. The loss on 100 short contracts at $13 per ounce moves $6.5 million against a $2.5 million margin deposit. The margin deposit is entirely consumed. The fund owes an additional $4 million. The prime broker issues a margin call. That is not a theoretical scenario. That is the arithmetic of what happened to every fund that was short silver heading into this week. Silver went from $82 to $95. That is a $13 move. At 16 times leverage on a 5,000 ounce contract, that $13 move represents $65,000 of loss per contract. For a fund with 100 contracts short, that is $6.5 million of losses on $2.5 million of deposited margin. The position does not just lose money, it goes negative. The fund owes money it does not have. A significant short squeeze is currently playing out in the silver markets, forcing short sellers to buy back silver to cover their underwater positions, which has amplified the price rally and caused a shortage, particularly in the London market. Yahoo Finance. When short sellers have to buy to cover, they are not buying because they want silver. They are buying because their broker's algorithm forced them to buy, at any price, whatever silver is trading at when the margin call deadline hits. Section 2. What a margin call actually is. The automated mechanism that Wall Street built to destroy itself. A margin call occurs when the value of an investor's margin account falls below the broker's required amount. Actors with significant capital who take substantial leverage positions face this mechanism when the price moves dramatically against them, compelling them to liquidate positions and exacerbating the price movement in the opposite direction. Trading key. Here is the sequence precisely. Step 1. Silver price moves against a short seller's position. Step 2. The loss reduces the margin account below the maintenance threshold. Step 3. The prime broker sends an automated margin call notice requiring additional funds by a specific deadline, typically the next business day's open. Step 4. If the fund cannot deposit additional margin, the prime broker's risk management system begins forced liquidation, automatically buying silver contracts to close the short position. Step 5, that forced buying pushes the silver price higher. Step 6, higher silver prices trigger margin calls on other short sellers. The cascade begins. The immediate implications of margin policy changes have been felt across the globe, triggering liquidation events that saw silver prices retreat from their highs in a volatile flash crash. By increasing the cost of maintaining leveraged positions, the exchange has effectively forced a massive deleveraging event, protecting the clearinghouse from the risks of a runaway short squeeze while simultaneously creating a liquidity vacuum. Energy news. That description is from the last major CME margin hike event. It describes what happened when the exchange raised margins and forced longs to liquidate. But the exact same mechanism works in reverse when the shorts are the ones getting squeezed. Forced buying by underwater short sellers is mechanically identical to forced selling by underwater long holders, except the direction of the cascade is opposite. When shorts get squeezed, the forced covering pushes the price up, which triggers more margin calls on more short sellers, which forces more covering, which pushes the price up further. Hedge funds and bullion banks hold the largest short positions in the silver market. These institutions often short silver through COMEX futures contracts as part of trading strategies. Some estimates suggest these institutions collectively short over 200 million ounces of silver through paper contracts. These large players face the biggest risks during a squeeze. When silver prices rise quickly, they must buy contracts to cover their short positions. This buying pressure can push prices even higher. The burning platform. 200 million ounces of institutional short positions against a registered vault with 86 million ounces of physical metal, against a market that just moved $13 in 5 trading days. The funds sitting on those short positions spent this weekend calculating whether they have enough margin to survive Monday morning's open. Some of them already know they do not. Section 3. What happened Friday at 3:52 p.m., the $429 million signal nobody explained. At exactly 3:52 p.m. Eastern Time on a Friday, someone bought $429 million of silver miners ETF calls, the majority expiring in only 3 weeks. Only 8 minutes before the market close, after silver had already soared, a single entity placed a massive directional bet on junior silver miners. To put this number in perspective, the entire market cap of CLJ is $2.67 billion. A single entity placed a $429 million bet on an ETF with a $2.67 billion market cap expiring in 3 weeks, 8 minutes before the close. JM Bullion $429 million in CLJ calls, 8 minutes before the close, after a large bullion bank reportedly received a margin call it could not meet on its silver short position. I want to be precise about what this trade means and what it does not mean. The trade is documented, the size is documented, the timing is documented. What is not documented is the identity of the buyer or their specific motivation, but the analytical question is straightforward. Who makes a $429 million directional bet on junior silver miners expiring in 3 weeks, placed 8 minutes before a Friday close? The answer has 3 possibilities. 1. A fund that is extremely bullish on silver and is using leveraged options on miners to maximize their upside. 2. A fund that is covering a short position in physical silver or silver futures and simultaneously going long miners as a hedge. 3. A fund that knows something specific about what happens when Monday's market opens, specifically that a short squeeze in silver will drive miner prices significantly higher within 3 weeks. The primary beneficiaries of margin hike events appear to be large bullion banks and institutional players who held significant short positions. The margin hikes provided these players with a much-needed circuit breaker, allowing them to cover positions at lower prices as retail and mid-sized hedge funds were squeezed out of the market. Energy news. The $429 million CLJ trade is not proof of anything, but it is a data point, a specific documented data point that sits at 3:52 p.m. on a Friday when silver was under maximum delivery stress, margin calls were being issued, and the Asian markets were hours away from opening. The people who placed that trade had made a specific calculation about what happens next. Whether that calculation is correct is what the next week will determine. Section 4. The prime broker mechanism. How margin calls become Monday morning buying frenzies. Here is the specific mechanism that connects Friday afternoon's underwater short positions to Monday morning's price action, because the sequence has a precise timeline that most retail investors have never been shown. Friday evening. Prime brokers calculate end-of-day positions for all clients. For every client holding silver short positions, the prime broker's risk system calculates the current mark-to-market loss and compares it to the posted margin. Any account where losses have consumed more than the maintenance margin threshold gets flagged automatically, Friday evening through Saturday morning. Automated margin call notices are generated and sent to affected funds. The notice specifies the exact dollar amount of additional margin required and the deadline for receipt, typically Monday morning before market open. Saturday and Sunday. Fund managers assess their options. They can post additional margin by wiring cash to the prime broker by Monday morning. They can close other positions to free up capital. They can attempt to negotiate with the prime broker, or they can do nothing. In which case, the prime broker's risk system will begin automated forced liquidation when markets open. Sunday evening. COMEX electronic futures open at 6 p.m. Eastern. Shanghai has been trading for hours. The funds that could not source additional margin are now facing their deadline. Some will have negotiated extensions. Some will have posted cash, but some will not have been able to do either. Those funds' positions begin getting closed by the prime broker's automated system the moment the electronic session opens. CME's silver volatility index sat above 80 into the move, which basically screams big swings ahead. When that lines up with a margin squeeze, you get forced selling, or in this case forced buying, by design, not by conspiracy. The principle is straightforward. Crowded leverage combined with a rule change or volatility spike equals forced exits. The mechanics are identical regardless of direction. Substack forced buying, by design, by algorithm, at whatever price silver is trading when the execution order fires. The funds that cannot cover their margin calls do not get to choose the price they pay to close their short. The prime broker's algorithm buys at market. If silver is at $86 when the algorithm fires, they buy at $86. If Shanghai has pushed it to $90 by Sunday night, they buy at $90. The forced covering does not negotiate. It executes. Section 5. The caught data. What the Commitment of Traders report says about who is short and how much. Let me give you the specific positioning data from the most recent CFTC Commitment of Traders report, because the scale of the short positions that are now underwater is documented in a public government filing. The Commitment of Traders data for COMEX silver shows a dramatic shift in managed money positioning. July 1st, 2025. Managed money gross long 59,288 contracts. Gross short 14,301. Net long 44,987 contracts. September 30th, 2025. Managed money gross long 49,927. Gross short 14,906. Net long 34,921 contracts. December 30th, 2025. Managed money gross long 29,100. Gross short 15,092. Net long 14,008 contracts. February 10th, 2026. Managed money gross long 12,222. Gross short 7,653. Net long just 4,569 contracts. Disruption banking. The net long position of the managed money category collapsed by nearly 90% from July 2025 to February 2026. The managed money speculators, the hedge funds and commodity trading advisors, have been systematically flushed from their long positions over 7 months of margin hikes and price crashes. What remains is a market where the speculative long base has been almost entirely eliminated, and what is left are physical buyers and the short sellers who are now facing a price that has moved significantly against them. With managed money gross and net positions the smallest in years, it would appear the COMEX silver price is ripe for a rally if big speculative money begins to return. Disruption banking. The managed money category is at its smallest net long in years. The speculative froth that CME was allegedly trying to remove through 6 margin hikes has been removed. What is left is not speculators. What is left is institutions that want physical metal. JP Morgan stopping delivery contracts, Bank of America demanding bars, Sprott acquiring physical through its $2 billion program, and the short sellers who sold paper against a vault that has lost 64% of its registered inventory. Those two forces are headed for a collision. The margin call mechanism I described in sections 3 and 4 is the detonator. The COT data is the powder. And Monday morning is when we find out whether the fuse has reached the charge. Section 6. The 1980 precedent. What Silver Thursday tells you about what happens when margin calls cascade. In the late 1970s, William and Nelson Hunt amassed a substantial portion of the world's silver using futures contracts to leverage their purchase. Their activities eventually culminated in Silver Thursday on March 27, 1980, when the price of silver collapsed 50% in a single day, following its peak price of $48.70 per ounce. The Hunt's inability to meet margin calls resulted in a crisis within the silver market, illustrating the potential for price manipulation through futures contracts and the significant impact of such acts on the market. Trading key. Silver Thursday 1980 is the most important precedent in this analysis. And most people get it exactly backwards. They remember that silver crashed on Silver Thursday and conclude that margin calls are bearish for silver. They are missing what happened in the weeks before Silver Thursday. Silver went from $11 in late 1979 to $50 in January 1980, a 354% move in 3 months. That move was driven in significant part by the cascading short covering of the institutions that had been short silver as the Hunt brothers accumulated their position. The margin calls on the shorts drove the price from $11 to $50. Then COMEX changed the rules to liquidation-only mode. The long side faced its own margin crisis, and the price crashed. CME's actions are reviving memories of two defining silver peaks, 1980 and 2011. In both cases, aggressive margin hikes came near the top of historic rallies and triggered forced deleveraging. In 2011, silver surged from $8.50 to $50, fueled by zero interest rates, quantitative easing, and the European debt crisis. As prices peaked, CME raised margins 5 times in 9 days, forcing leverage funds out of the futures market and sending silver tumbling nearly 30% in weeks. One news page. In 2011, the margin hikes came at the top. They hit the longs. Today, the margin hikes have come throughout the rally, 6 times since November, and have already flushed the managed money long base by 90%. What is left after flushing the longs is a market where the remaining participants are physical buyers and leveraged shorts. When those shorts face margin calls, there is no speculative long base left to sell to them at suppressed prices. The only sellers are the physical holders. And physical holders in a market with 34.9% lease rates and a 64% vault drain do not sell at $84. Section 7. The bear case. Why the margin call cascade may not happen the way this analysis implies. I always give you both sides. The bear case on the weekend margin call thesis is coherent and you need to hold it. Separate mechanics from myth. The margin squeeze rumor plays well because it echoes real history, like past metals manipulation cases. Old CFTC and DOJ documents show big banks paid heavy fines for spoofing and deceptive activity in metals markets years ago. So when you see silver spike then crash and a claim about a mystery bank margin call, your brain joins the dots. But your money cares about rules, not stories. Exchanges publish margin changes. If someone claims a hidden bailout or a forced liquidation, your first stop should be those public filings, not speculation. Substack. That is a fair methodological point. The weekend margin call thesis is built on documented mechanics, leverage ratios, margin requirements, the sequence of events when maintenance margin is breached. What it cannot confirm with certainty is the specific current positions of specific institutions. We know the COT data shows managed money gross short positions at 7,753 contracts as of February 10th. We do not know exactly where those shorts entered, what their margin situation is today, or whether they have already received and met margin calls this week. The second bear argument, silver is at $84, not 95s. The most violent upward move happened Monday through Tuesday of this week when silver hit 95. By Friday's close, silver was back at $84. Funds that were short at $82 and watched silver spike to $95 faced maximum margin stress on Tuesday. If they met those margin calls, depositing additional funds or closing positions, then Friday's $84 close represents a reduced threat level relative to peak stress. The funds that survived Tuesday are better positioned for Monday than the Tuesday open implied. The third bear argument, CME has another tool. A series of aggressive margin hikes to stabilize the silver market has been the exchange's response when speculative frenzies threaten systemic clearing risk. If the situation demands it, CME will raise margins again. Qcoin, a Sunday evening margin hike announcement, the 7th in this cycle, would actually relieve pressure on the shorts by crashing the paper price and giving them a cheaper cover point. The bear case on the margin call thesis is that CME uses the margin tool preemptively before the cascade has a chance to develop. The exchange has shown it is willing and able to do exactly this. The fourth bear argument, the $429 million CILJ trade. The question about whether a large bullion bank was about to be liquidated after being unable to meet a margin call remains unanswered. The facts are the facts, but are we looking at a strange string of coincidences? JM Bullion. That caveat from the original reporting is the honest framing. The SILJ trade is documented. The interpretation is not. It could be a short covering hedge. It could be an unrelated bullish option strategy. It could be a directional bet with no connection to the margin call story. The trade is real. The story around it is inference. Section 8. What to watch. All free, all public. I sell nothing. No memberships, no Discord, no paid alerts. If you see my name on any paid service, that is not me. You find me here on YouTube and on X where data breaks when it happens. Your specific watch list from right now through Monday morning open. COMEX electronic session open. Tonight at 6:00 p.m. Eastern. This is the first Western price signal of the week. Watch whether silver gaps up or down from Friday's $84 close in the first 30 minutes. A gap up above $86 in the electronic session's first 30 minutes suggests margin call forced covering is active. A gap down below $82 suggests a CME margin hike was announced Sunday evening and is crushing the price before the open. CME Group margin announcement page. Watch specifically for a Sunday evening announcement. Every prior hike this cycle came on a Sunday night. If CME is watching the same short squeeze dynamics I just described and decides to intervene preemptively, the announcement comes before the Monday open. Its absence as of 5 p.m. Eastern tonight is itself a data point. The exchange has decided not to protect the shorts with another margin hike before Monday's open. Shanghai Gold Exchange price, currently trading or just closed depending on when you watch this. The SGE price versus the COMEX electronic session price is the real-time premium signal. If SGE is running more than $5 above COMEX electronic, physical demand is confirming the margin call thesis. If SGE is flat or slightly below COMEX, the physical market is not adding to the squeeze pressure. SILJ, opening price Monday. The $429 million options bet expires in 3 weeks. Watch whether SILJ gaps up significantly on Monday's open. If the miners gap up 5% or more at the open, whoever placed that $429 million bet is currently in profit, and that trade's timing relative to the margin call sequence is no longer a coincidence. It is a data point with a specific directional implication. Prime broker margin call disclosures. These do not come in real time. They come in regulatory filings, earnings calls, and news reports that typically appear days after the events. But watch for any report Monday of a fund reporting forced liquidation or a significant silver-related loss. Those reports, when they come, are the confirmation of what happened over the weekend. Section 9. The honest conclusion. Here is the full picture as of Saturday night, March 8th, 2026. At $84, a standard COMEX silver contract represents $420,000 of exposure against a $25,000 margin deposit. That is 16.8 times leverage. A violent week can turn into a scramble for cash. Financial content managed money net long positions collapsed from 44,287 contracts in July 2025 to just 4,569 contracts by February 10, 2026, a 90% reduction. The speculative long base has been systematically flushed. Disruption banking. Hedge funds and bullion banks collectively hold an estimated 200 million ounces of silver short positions through paper contracts. These large players face the biggest risks when silver prices rise quickly. They must buy contracts to cover their positions, and that buying pressure pushes prices even higher. The burning platform. At 3:52 p.m. Eastern on Friday, someone bought $429 million of silver miners ETF calls expiring in 3 weeks. 8 minutes before the market close, after a large bullion bank reportedly received a margin call it could not meet on its silver short position. JM Bullion. Silver moved from $82 to $95 this week. The funds that were short at $82 faced losses of $65,000 per contract on that 13-year move at current margin levels. The managed money short base is documented at 7,653 gross short contracts. That is 38.265 million ounces of paper short exposure. Some of those positions have already been covered, some have not. The ones that have not are receiving margin calls this weekend. Monday morning's open is not a prediction market. It is the documented outcome of a mechanical process that started when silver moved to $95 on Tuesday and has been running through prime broker risk systems every night since. The margin call is not a theory, it is arithmetic. Whether those margin calls produce a Monday morning short squeeze or whether CME uses a Sunday evening margin hike to protect the shorts before the open, that is the question. The answer comes in approximately 36 hours. Pull the CME margin announcement page at 5 p.m. Eastern tonight. Watch the COMEX electronic session at 6 p.m. Eastern. Check the SGE premium. And let the data tell you whether the weekend bloodbath that happened behind closed doors translates into visible forced buying when the markets open Monday morning. Invest with logic, not hype. Protect your capital. Margin calls are not rumor. Leverage is mathematics. And mathematics does not wait for Monday. Drop margin watch in the comments if you are tracking the COMEX electronic open tonight, and drop squeeze or no squeeze to tell me what you think Monday morning's open looks like from where you are sitting right now.